Okay, we're up to 16 people. We'll get started in a minute. Still don't see any more people in the waiting room. Okay, so let's just get started. So welcome to the last class of quite an unusual course. I've taught this for 8 years, and this is the first time it's been online. And yeah, I guess we just have to wait and see if it goes back to normal in class next year. Certainly hope so, because it's all more fun meeting in person and just seeing everybody in person. But I think we've made the best of the situation. So let me start sharing the slides. And like I said, I'll cover some material up until around 7-ish, and we'll take a break, and then I'll wrap up by around 8 o'clock, hopefully, to make up for the amount of work we did yesterday. Okay, let me start sharing. Oh, a couple more people, great. So I can't find my slides. Wait a second, I don't know why I'm not seeing my slides. Wait a minute, I'm going to close some windows. But, okay, there we go. Yeah, let's start from the beginning. So just to review what we covered yesterday. So we opened up the box on hedge funds and figured out how value add or alpha is created. So we talked about ways that you could create fake value add. But then we talked about all the ways you could generate genuine value add or alpha. And alpha is taking advantage of market inefficiencies. And we had this framework for there's 5 different areas where you could look for market inefficiencies. Those are dislocations, non-economic participants, artificial constraints, arbitrage, and relative value relationships. And we didn't cover it so much, but there is also surrounding that alpha generation process, there's a whole aspect of running a business on top of that. And so you want to make sure that you have good policies and risk management and cost control and execution and all those good things to support the alpha generation. And then we talked about hedging, and we distinguished between normal regimes and stress regimes. And we talked about tail hedges can be used to reduce drawdowns during stress regimes. And we also talked about the idea of risk on versus risk off assets, and the idea that in a stress regime, so that would be like a market crash, that risk-on assets become all correlated to each other, and risk-off assets become all correlated to each other. And generally, risk-on and risk-off assets become negatively correlated, highly negatively correlated to each other. And so we can take advantage of that correlation behavior in the tail to come up with tail hedges. So we spent some time talking about that, and we also talked about currency hedging and showed some examples. Okay, so before we get into the main material, let's cover our special topic. This one is more of a fun exercise, and it's more of it's almost like a mini personality test to see if you have like the natural personality to be a good investor or a good trader. So it says there's no right or wrong answer, but that's not really quite true. There are probably better answers than others. But let's just go through the exercise. So in the first scenario, you can either win. You have a 50% chance of winning $1,000 or guaranteed of getting 500. So obviously, you know, on an expectation basis, those two scenarios are the same. So if you got to play this game repeatedly, the outcome statistically would be the same. And then scenario two, it's the same setup, except instead of a gain, it's a loss. So you get a 50-50 chance of a loss and versus a guaranteed loss. And then what the exercise for you guys to do is to figure out, okay, in scenario one, would you pick the chance of doubling your gain, or take the certain $500, or, and similarly in scenario two, what would you do? And so then there's obviously a 2x2 scenario, and then you can come up with what your kind of profile is. So let me see if I can actually switch to the use the whiteboard to a little bit to show the idea. So let me just draw some axes. So if this is your, let's say this is P and L on your trading over time. So here's the intuition that if you're willing to take the risk for the gain, but you don't want to take the guaranteed loss. So that means you're kind of symmetrical. So if you're, I can't remember the letters, so either you're an AA or BB. So that kind of so you're willing to take the chances on both the upside and the downside. So that creates a kind of relative. Oh, it's a pretty bad drawing, but anyway, it creates like a kind of like, you know, a pretty volatile pattern. It probably trends upwards, given that, you know, in the markets, unlike you know, a casino. So we're talking about like, if you're how you answer the questions under these scenarios is meant to be an indication of how your trading P&L profile would look like actually trading live. And since you're trading, you're generally not making 50-50 bets, but rather the odds tend to be in your favor to make money, just because you're taking risk by investing. So you would tend to kind of drift upwards, but you would have some volatility. And then obviously, if you're very like take the guaranteed gain and guaranteed loss, you probably like a similar profile, but less volatile. So then the other cases where let's say you're willing to continue to gamble on your gain, but then on your losses, you cut your losses. So you'll take, rather than risking losing more, you say, okay, I'm gonna truncate my losses and recognize them right away. But on the upside, you're willing to let your winners run, so to speak. So that profile, and let me switch colors. So let me do green. So that's more like will tend to do better, because the idea being is that the person with that personality type will have a better risk management. It will be naturally better risk management process, meaning that instead of hoping that a loss will recover over time, they're willing to sell it and take the proceeds and invest in a better investment. And so then the opposite case more looks like would be kind of like this pattern. So what that pattern, this pattern is somebody that they will put on a trade. They'll make a small profit on that trade, and then they'll want to lock in that profit, so they'll sell it, and so take their kind of guaranteed locked in gains, but they're not willing to let their kind of winners run. So in other words, to keep going up, whereas their psychology is such that they don't want to lock in the loss, so they will rather than lock in the loss, they will hope that the losing position will somehow recover, which means that they're not able to take the opportunity to reinvest that money in something more profitable. So, you know, I can like think of an example. Like, let's say you invested in BlackBerry or Research in Motion, and that stock continued to go down, and so you held on to it hoping that it would recover, but it actually still continued to go down, and it essentially got to a point where it's effectively what people would call as dead money. In other words, it's become such a small position that it's really not going to recover, like make any meaningful contribution to your portfolio, even if it does recover. Um, Whereas somebody else with a different personality profile would have cut their losses quickly and then reallocated that money, and maybe they would have reallocated it into Amazon or Apple, and they would instead of taking their gains in Amazon and Apple, they would let those gains continue to accumulate. And so again, to reuse the phrase, let their winners run. So instead of getting bogged down in holding Research in Motion, they would have quickly moved on to something more attractive, and so they would have done significantly better. So you can almost think like, you know, that green profile is the case of somebody switching to say Apple or Amazon. The red line is somebody holding on to Research in Motion, just as an example. So I think that's like a fun exercise and something for you to think about. And so you probably recognize that this is like skimming the surface of behavioral finance and loss aversion, and there's this idea, like another rule of thumb, that people are psychologically feel the pain of a loss twice as much as they feel the pleasure from a gain. So even though you know, like rationally, that those things are equal, but you have to recognize that your emotional reaction to them can be different, and you want to be self-aware enough so you don't let those behavioral characteristics interfere with your investing. So hopefully you guys can take something from that. So let me now switch over from this into the main topic for today. Yeah, okay, so let's do the case. So yeah, I'm sorry, I sent out the materials a little bit late, so I don't think you guys had enough time to read the case. But I'll just kind of walk you through it. So let me open that up. So I'm going to share my notes on the case as opposed to opening up the case. And yeah, and then there's an exam question review afterwards. So I'm just going to tell you what the questions were and then what the answers were. So the example is that you're commenting on the LDI program of a pension. And on a mark-to-market basis, the liabilities, or sorry, the assets are only 80% of the liabilities. So in other words, you're underfunded. But on an accounting basis, you're fully funded. So then the question is, should you be hedging your liabilities based on the accounting valuation or on the mark-to-market valuation? And so your initial reaction should be to say that it should be done on a mark-to-market basis, because that more reflects the economic reality. But the reality is actually it depends, because the actual valuation actually is important, because typically what will happen is that's what you'll officially report. So let's say you hedged the full amount, but it could end up being that if you hedge based on the mark-to-market valuation, you actually may end up like over hedging. And so if the market moves in such a way that it could be on a mark-to-market basis, you're fully funded, but on an accounting basis, due to your hedging, you're actually underfunded on an accounting basis. So, and it's accounting basis that you have to report. And so in that case, you should actually be cautious about hedging to the mark-to-market. In fact, you probably want to hedge to the accounting valuation, even though it's not reflective of the economic reality. And obviously, those two things should ultimately converge, but it's more of a matter of timing. So it could take, let's say it could take 10 years for the accounting valuation and the mark-to-market valuation to converge. But let's say you have to file an accounting valuation every 3 years, which actually is indeed the case for pension plans in Canada. So if it hasn't converged in that time, your best strategy is to hedge to the accounting valuation. Then the second question was to say, okay, well, let's say your liabilities are say $100 and your assets are $80. So the question is, should your hedge size be based on the liability size of 100 or on the asset size? And so the answer to that one is actually more straightforward. The size of your hedging program should actually have nothing to do with your asset size. It should have be determined by your liability size. So that's a straightforward question. And then the third question was that if you're able to find a derivative instrument that fully hedges your liabilities, should you enter into that derivative contract? And the theoretical answer is yes. In fact, you should be quite eager to do that. And the reason why is because it fully solves your liability hedging program. And from once you have that liability hedge in place, all you need to do now is focus on your constructing your maximum Sharpe ratio portfolio. So it simplifies your life tremendously. But then there's the kind of market mechanics that you have to take into consideration. And so remember, we talked a lot about liquidity management and margin calls. And so it could be that you put on this derivative hedge, but it could result in very large margin calls. And so you need to ensure that you have the liquidity to manage those liability calls. But subject to that constraint, then yes, you should be hedging your liabilities, given something that's a perfect hedge, which is very rare. And yeah, and then the other question was to say, well, if I'm not fully funded and then I become even more underfunded, should my strategy be to take more risk to try to catch up, or to be thinking I should actually hedge more so I track my liabilities closer? So in other words, so that question is conditional, and it depends on how far away you are from fully funded. So if your mindset or your strategy, if you're underfunded but you're still not that far away, so I would say, like, anything above, say, 70% fully funded, you probably want to be taking risk to try to catch up. However, once you get severely underfunded, you're no longer worried about trying to become fully funded. Now you're more worried about actually becoming insolvent. So now your priorities have shifted, and now you're more concerned about just surviving. And at that point, you'd be more focused on just hedging what you have remaining. So you can see how it's a tricky management situation. Um, uh, then the last question in the case was that what should be the correlation for an asset to be considered as a hedging asset. So for example, let's say, to make it simple, your liabilities are the S&P 500. So for whatever reason, you need to deliver the return of the S&P in 10 years time. And so obviously what the best thing for you to do would just simply to purchase S&P today and then hold it for 10 years, and then you deliver that S&P 500. So that's that. In that example, that hedge is 100% correlated to the S&P, or sorry, to your liabilities, using the S&P as an example. But let's say you weren't able to find, like, your liabilities weren't so simple. So let's say that, so an asset that was uncorrelated wouldn't be any use to you whatsoever. So as a hedge, so there's got to be some number in between, like a zero correlation and 100% correlation, where something goes from like a not very effective hedge to an effective hedge. So the question was, like, what is that number? And so uh, a kind of a rule of thumb, but in practice that number is probably about like 70% correlation or better, or 0.7. And then the question is, well, can you estimate this mathematically? And you can do an exercise by considering the volatility of your liabilities, and then you can imagine having adding on a hedging position, and that hedging position will have two effects. One, it'll tend to increase the volatility of the portfolio, just because you're adding more, like another volatile asset to it, but it will also decrease the risk due to its hedging properties. So there's a competition between these two effects, and so what you could do is do a little calculation and figure out where, if there's a balance. So it turns out it's not like a a calculus problem where you can like just find like the derivative and set it to zero, but you'll find that there's like a number that looks kind of um, uh, looks like an effective hedge, and there's certainly correlations below which it's not an effective hedge at all. So you can use math to give you some kind of intuition, but it won't give you an exact number. Okay, so now let me share the lecture material. So I'm going to turn back. Okay, so probably, I think I've shared this information a lot with you already, but just to review the exam, which will be on Monday at 6 p.m. So let me remind you that if you want the exam at a different time, you need to send me an email requesting that and tell me what time you want it at, and express it in my time so there's no confusion. The other thing is that you're going to have to state that you're not going to share the exam with others or ask others to share with you. So I just want you guys to explicitly commit to that, because I'm unlikely to prepare two totally different exams. So keep that in mind. So only one person has so far requested a different timing, which is great. Like for me, it's most convenient if it's just one or two people. But just keep that in mind, that you're running out of time to let me know. And the exam content, so the 3 assignments were worth 20% each. Exam is worth 40%. As I mentioned, there'll be, I'll give you 6 questions. You have to answer 5 of them, all equally weighted. the topics will come from these 6 different categories. You know, the hedging may cover liability. Like I would consider LDI as under the umbrella of hedging, because it's really hedging your liabilities. But anyway, the efficient frontier, portfolio construction, investments, value add, fees, and hedging. So those are the topics. I believe we've gone through an example question of everything, and once I show you the hedging example today, you'll have literally seen a sample question for everything. So you should have an excellent idea of the types of questions that will be on the exam. Obviously, I'm going to try to tailor the questions so that it takes into account that it's that you'll have access to your notes. So it won't just be a simple derivation of something we've done in class where you could just simply copy the answer, because it's not very insightful. Yeah, I think I mentioned sending, in this case, I want you to send me a single PDF document as your response. Obviously, the PDF is unable to, or I guess I should say, more difficult to anybody to edit after the fact. So likely it's not impossible, but it's safer. So keep that in mind. And yeah, so obviously I wish you all the best of luck in your exam, and I'm sure it'll be good, just same as it's been all the other years. We've done the case. Okay, so now I want to talk about LDI and or liability-driven investing. We talked about this at the very beginning of the course, where we kind of set aside liability hedging to focus on the maximum Sharpe ratio portfolio, and the reason was because individual investors will tend to have like unique liabilities. So every pension will have slightly different liabilities, endowments will have different liabilities. But there is some general things we can say in terms of how much of our assets we want to put in the to hedge liabilities versus the maximum Sharpe ratio portfolio. So we're going to go through a little mathematical toy model to show you that. I'll probably skip some of the details and the steps in the interest of time, but I'll just talk about the intuition that the final result gives us. So let me just motivate the discussion by talking about the questions on the slide. So if the assets have gone up 10%, but the liabilities have gone up 20%, have we done a good job? And so, you know, you could see, like, let's say, you know, pick teachers as an example. We report a headline return of 10%, and so everybody think, yes, that's pretty good job. But in fact, if you drill a little bit deeper, we actually fell behind our liabilities by 10%. So in fact, since our objective is not to make the highest return possible, it's to actually meet our liabilities, we actually have not done a good job in that case. Then another more tricky case is if we've lost 10%, but then liabilities lost 20%, have we done a good job? The theoretically correct answer is absolutely yes. The more difficult answer is that people are still not going to be happy with that. So they will not kind of recognize that you did better than the liabilities. They'll just focus on the losing of the 10%. So what that means is that as an asset manager with liabilities, you actually have a more difficult job, just because people don't fully appreciate thinking in relative terms, so that not only should you be trying to beat your liabilities, but you should also be trying not to lose money on an absolute basis. And so while so that is actually like the strategy that teachers follows. So we kind of have both those objectives in our mind, that we want to generate like an absolute return, and we also want to track our liabilities. And so if you think about it, and this is kind of the Warren Buffett philosophy, and I sent you a reading, and again, I really doubt you had time to read it. But Warren Buffett's philosophy is, in terms of pension management, is to say, well, I know the pensions will get, the liabilities will get valued however they get valued. I'm just going to set that aside, and like, this is Warren Buffett speaking, and I'm just going to focus on making like as much money as possible in a reasonable fashion. So not excessively risky fashion. So he's following like a wealth maximization strategy. And we've talked about this before in terms of betting and Kelly criteria. So that's his philosophy. And he's actually managed the pension plans for some of the companies that he's owned. And the letter I sent was, he's talking about the issues of pension management back in the 70s, and he was actually extremely insightful. He had like a much deeper understanding of pensions at the time than most other people, and so he's clearly a very smart person. So even though he comes across as all very folksy and whatever, you can tell from his writings he's very, very sharp. So what he did for the pensions is he instead of getting like a pension manager and constructing like a diversified portfolio, he just him and his partner Charlie Munger just picked a basket of stocks, and that was it. And it turned out that over a long period of time, those baskets of stocks made more than enough money than the growth of liabilities. And so this was a situation where that pension wasn't constrained by showing they're fully funded on any particular year, whereas that's the case for like pension plans like teachers. So we wouldn't even be allowed to do something like that, because it could be like, let's say the stock market crashes, we would show on that particular year that we were dramatically underfunded, and that would not be acceptable to our regulators and our members. And so even though over the long term, stocks are the highest returning asset classes, and over the long term, you will almost certainly end up with more than enough money to pay your liabilities. But the path to get there for institutional investors is not acceptable. Whereas Warren Buffett didn't care so much about the path, and was able to kind of exploit that ability to more than meet the pension liabilities. So so that's one of the key things about a liability investing is that you're not concerned about the volatility of your assets, but you're concerned about the relative volatility. So the volatility of your assets versus your liabilities. So if you have assets that track your liabilities, then that volatility is going to be significantly lower than otherwise. Okay, so I wanted to make sure that we're good on time. So yeah, it's only like 6:35, so that's good. So what I'm going to do is I'm going to walk through the model, and then we'll take a break, and then we'll come back, and I will walk through the question, and then we'll wrap up the course then. Yeah. So let me just set up the situation for the model in the first place. So one of the things to appreciate, and this will come through in the exam question that I'll cover, is that for pension plans, a lot of times the liabilities are indexed to inflation, which makes them more valuable, because when you do like a present value of inflation-linked liabilities, you discount it at the real yield. So whereas if you had nominal liabilities, you discount them at the nominal yield. So to give you an example, like let's say uh, I had to pay out like a dollar every single year forever. And if that dollar is just like a nominal dollar, in other words, it was like a stated dollar forever, my nominal discount rate could be 5%. And so what that means is the value of my liabilities is $20. So $1 divided by like 5%. Now consider the case where that dollar grows with inflation. So this year it's $1, but next year it's like $1.02, and then next year it's like $1.04.1. You get the idea. So it's going to compound. So clearly that receiving a real dollar, so in other words, aka a dollar that goes inflation, is much more valuable than receiving a nominal dollar. And so the real yield, if the nominal yield is say in my example is 5%, to make it make the math easy, let's say inflation was 3%, and so that means the real yield is 2%, because the real yield is the nominal yield minus inflation rate. So now my real yield is 2%. So then my dollar would be worth, my liabilities are now actually $50. So $1 divided by 0.02. So I can't remember what the value was under the nominal case. I think it was like $10. But anyway, the point is that the liabilities are significantly more valuable under if they're inflation linked. And it turns out like most pension plans, liabilities are inflation linked. So that's one key insight that you should be aware of. The other insight is that the pension liabilities goes out for many years, like out to, like there's still expected cash flows going out to like 70, 80, 90 years. And so you could have cases, like I'll give you an example. So somebody starts working in the pension plan at their 25, and then they're going to work for, let's say, 30 years, and then they'll be retired Yeah, sorry, my internet dropped out there, so I had to reconnect. So actually, we've been pretty lucky so far, um, all things considered. Anyway, so let me carry on. So let me go back to the sharing of the PowerPoint. Hopefully, it doesn't happen again. So what I was talking about was, sorry for the slideshow to come back. Yes, what I was talking about how that there's not enough, there's there's not enough bonds with maturities. We Okay, so I'm back. So yeah, I sent you guys an email just to let you know, but my home internet was getting unstable, so I just restarted, and hopefully it's good. So for the second attempt, let's go back, try to finish this slide. Maybe this slide is cursed. So yeah, so repeat the message is that pension plans have liabilities about for cash flow liabilities about in the decades. There's not enough bonds to match all these cash flows. So what we do is instead is we say, okay, well, what's the duration of these liabilities? So that'll be something like some number like say 25 years or something like that. And so then what we try to do is um, have a portfolio that matches that that duration. And so typically what that means is that your liability hedging portfolio would be very much uh, inflation-linked levered bonds. So that's the ideal hedge. Um, yeah, and that's the first order risk. There's lots of additional risks, but if we can't even match the first order risk. So given that, there's no point in worrying about these other risks. And yeah, the reason why is this because it's not there are not enough assets out there to uh, with sufficiently high correlation to match our liabilities. And what I mean by that is that if you look at the Canadian RB bond market, it's uh, it's just not big enough to satisfy the hedging needs for all the pension plans. So let me skip a lot of this stuff um, and get to the results. So yeah, this is the main formula. And so what I'm going to do is walk through the formula a little bit. But let me describe what you're looking at here. So this is the LDI, sorry, this is the maximum Sharpe ratio portfolio, or which you're very familiar with because we derived the weights for it. Remember, it was like um, the inverse of is proportional, the weights are proportional to the inverse VCV matrix times the excess return vector. So that's exactly what that guy is. This liability hedging portfolio, this is a portfolio, instead of maximizing the Sharpe ratio, it's a portfolio that maximizes the correlation to the liabilities. And then what this says is that you want to, then there's cash here. So remember, this is like kind of like maybe the this is like a three-fund separation concept, whereas this cash is the risk-free asset portfolio. And so then when we look through this, this lambda here, I'm using the same notation as EdHec, where they derived these formulas. And so I'm just following their notation. And their notation is lambda is a Sharpe ratio. And so, and this is the volatility. So of the RDI portfolio, so the Sharpe ratio of the RDI portfolio, or maximum Sharpe ratio portfolio, the volatility of the maximum Sharpe ratio portfolio. If you guys recall from the very first lecture, we actually derived what the optimal leverage was. That's actually exactly this quantity, the Sharpe ratio divided by the volatility. And so this is the optimal leverage to the maximum Sharpe ratio portfolio. And then we have this risk aversion parameter. So remember we said that you may not necessarily want to run at the maximum theoretical leverage. And then the liability hedging portfolio is weighted 1 minus the amount in the risk aversion. And then it's also scaled with this beta term. This beta is the beta of your liability hedging portfolio to your liabilities. So for example, that beta is going to be a function of both the correlation of your liability hedging portfolio to the liabilities and the ratio of volatilities. So remember, beta is equal to correlation times volatility divided by volatility of the market. In our particular example, our market is the liabilities. And so typically uh, the, the, the liabilities, since they're very high duration bond, so like if you have a liabilities of like a 30-year duration and a bond of 15-year duration, that means that the the liabilities have twice the volatility of the of the of the bonds. So in other words, the duration is proportional to the volatility, and so if the liabilities are twice the duration, then this beta is going to be 2. Um, actually, I think I've got it flipped upside down in this particular example, because I know I want the beta to be 2, because the idea is that I want to buy, if I have like $100 liability of 30-year duration, I'm going to want to buy $200 worth of 15-year duration bonds. So I know my beta wants to be 2. So I think when I described the beta, I should have put the volatility of the liabilities on the numerator and the volatility of the bonds or the liability hedging portfolio on the denominator. So I got that backwards. So the volatility of the liabilities is twice the volatility of the hedging portfolio. So therefore the beta is 2, and that's assuming that it's there's a perfect correlation. So anyway, I'm just trying to give you intuition what this beta means. And then typically the cash is going to be negative, because you're going to want to have a large bond portfolio to match your liabilities, but you're also going to want to have a large investment in your RDI portfolio to make returns to kind of keep pace with your liabilities. So this cash is probably going to be a large negative weight theoretically, and this probably what's going to happen is you're going to be in reality you're going to hit constraints on leverage, so you probably won't be able to reach the theoretically ideal mixture of uh, maximum Sharpe ratio portfolio, liability hedging portfolio, because you won't be able to borrow enough money. But this is just a theoretical intuition. See how we're doing for time. 7 o'clock. So I want to just show you. So this is setting up. Yeah, I'll just talk a little bit about where this model comes from. So we set up a simple toy model economy of stocks, nominal bonds, inflation-linked bonds, which hedge our liabilities, and cash, which is a source of leverage. We have all these like stochastic differential equations, bond pricing formulas drop out of those. Then you get like an equation, stochastic equation describing the dynamics of the liabilities. And then you go through all of the math, which is it's a little bit more involved than the math that we did for the deriving the maximum Sharpe ratio portfolio, but it's not that much more complicated, and it's the same style of math, like all these like matrices and vectors and operations with them. So fine. So what I want to talk about is a little bit more interesting idea that, remember we talked about that these weights tend to be static, so that you have your fixed weight RDI portfolio, your fixed weight LDI portfolio or liability hedging portfolio, and then you size those appropriately. But then the other thing is that we want to keep a good funding ratio. In other words, we don't want the funding ratio to drop too low, and we don't want the funding ratio to become too high. So when the funding ratio becomes too high, what that means is we've really made more money than we need to make. And so then we could say, well, let's somehow trade our portfolio in such a way that we give up that upside to hedge our downside. And so this is the idea of putting a floor and a cap on the funding ratio. So say you could put a floor on the funding ratio of like say 0.7 and a cap at 1.1. And so then what you're going to do is you're going to dynamically change the weights to your RDI and LDI portfolio such that you respect those caps and floors. And so you can imagine this is very much like engineering your return profile or like an option replication. So this is what we've done here. And so this shows the funding ratio without a cap and floor. This shows a funding ratio with a floor, and then this shows a funding ratio with a cap and floor. And so this shows like this is getting into like a more advanced topic. So this is why I kind of wrap up the course with this, just to give you a flavor of you know, if the course was, you know, there's like a more sophisticated or advanced version of the course, the types of topics that you would get into. So this, I don't expect you to fully get into the details of this, but it's just to give you a flavor of more advanced topics. And so you can see you're clearly, like in this third case, you're really, you know, this distribution is really not described as like a normal distribution anymore. It's kind of like, I guess, trimodal. It's got like a mode at the floor, a mode at the cap, and like a mode somewhere in between. So you're getting pretty exotic. Yeah, and then I have a slide of some more advanced topics, but I don't want to go into the details of those. So that covers the course material, everything I wanted to get across. And let me stop sharing. And yeah, so it's right at 7 o'clock. So maybe let's take a 15-minute break, and then we'll come back and I'll go through the final sample question, and then I'll open it up for you guys to ask any questions. And let me even just now just unmute you. So does anybody have any questions they want to ask before we go for a break? Okay, so if not, let's take a 15-minute break. I'm going to put myself on mute and turn my video off. Oh, actually, what I'll do, no, instead of doing that, I'm going to put the exam question up just so you guys have a chance to read it and think about it during the break. And then I'll come back at 7:15 and I'll answer the question for you. Okay, so here's a question. Okay, so I'm back, and yeah, let's go over the exam question. And yeah, it's a good question because it requires us, at least I found it required some thinking to answer what happens over the long-term horizon. But anyway, let's just work through the problem. So yeah, let me start with the first part. So we're trying to value liabilities that where there's a stream of cash flows of X that grow with inflation. And so this is very much a realistic model of a liability cash flow. And so that then what we want to do is we want to discount these cash flows. And so you discount at the nominal rate. I'm not using exponential notation, but you could have, but just use this notation. And so I'm left with this infinite sum here. And then what I do, maybe you remember the formula for infinite sum, or you can just derive it. But what I just derive it here. And then what I show is that when I substitute in what I'm calling A in my infinite sum, which is 1 plus CPI divided by 1 plus real plus CPI, I plug that into here, and I end up with the result that this infinite sum is 1 plus CPI over R. And that's quite a nice, elegant result. And in fact, it's simplified. Like you can write down a little bit even more elegantly, saying that the value of the liabilities is the next year's cash flow divided by the real yield. So that may look familiar to you in terms of a it's a little bit similar to the dividend discount model because essentially it's the same infinite sum. This is the value for a bond that pays out a, a, a coupon indefinitely, like it's called like a perpetual, or sometimes it's called a console bond. But anyway, this has got a very nice, simple pricing formula, and so that's all nice. So that answers the first part of the question, come up with the valuation for the liabilities that grow at inflation. And then the next part says, well, what if the liabilities grow faster than inflation? So let's say they grow as a spread on top of inflation. So that's pretty straightforward. All we do is we um, add a spread to our term that we're infinitely summing. And then we're left with this expression here for the infinite sum. And again, unfortunately, I cut out the picture, cut off a little bit, but the value of the liabilities with the spread is next year's cash flow divided by the real yield minus the spread. So I just want to check that makes sense. Yeah, the intuition is that this is higher yielding, so it's more valuable to you. So the numerator is a smaller number. Okay, so that's my thought process. I just hope I haven't made any math mistake, but just doing a quick check. Yeah, looks fine. Okay, so so now we've got the value for the liabilities, and then the question asks, okay, well, what if you have liabilities that grow with CPI plus a spread? And so here's the question: what if the liabilities grow with the inflation plus a spread, and you hedge them with with assets that only grow at CPI. And furthermore, the assets and liabilities have the same duration and the same starting market value. And so the question is to explore that situation. And this is a part where it's like the math part of the question was pretty straightforward, but this part requires, at least like from my perspective, a little bit of thinking. So one way to think about it is that the assets are yielding the real yield, whereas the liabilities are yielding the real yield plus a spread. So in other words, they're higher yielding. And so since the assets have the same duration, they will act like as a good hedge, but the assets aren't risky enough to keep up with the income stream of the liabilities. And so let's think about that a little bit further in a way that maybe is a little bit more intuitive. So you could think of this example is very similar to the case where I have $100 of 10-year investment grade bonds versus $100 of 5-year investment grade bonds. Sorry, high yield bonds. And so you should be aware of, at least from this course, that by now that two facts. One is that investment grade bonds have a lower yield than high yield bonds. And the other thing is that high yield bonds are riskier, so that to kind of equate the risk of these investment grade bonds versus high yield bonds, I have a longer duration for the investment grade bonds than the high yield bonds. So longer duration, lower risk equates to a shorter duration, higher risk. So I think your intuition is that the investment grade bond portfolio has a lower yield than the high yield. So what that means is that and I go through a little example here, that if your assets are like the investment grade portfolio, then they're generating like 4% each year. And the example I consider is, just to keep things simple, let's imagine that yields don't change over the whole life. And so every single year, the investment grade bond will pay a 4% coupon and it will maintain its par value. Similarly, the high yield bond will pay its coupon of 6% and also maintain its par value of 100. So the assets in terms of value matches the liabilities perfectly every single year. The only thing is, in this toy model, is that they're not the assets are not generating enough yield to match the liabilities. So that's one perspective you could take, that it's the assets aren't risky enough to generate the income required. Or the other way you could think about it is that you could insist on matching the income, but what that would mean is that you would need to sell 2% of the assets to make up for the difference between the 4% and 6%. And so you can imagine doing that over time, that you would slowly eat away at the assets, and so you have less and less assets and eventually, obviously, you'd drift. Your funding ratio would drift further and further lower because your assets just couldn't keep up with the liabilities. So I think that gives like a couple of perspectives on thinking about this problem. And so to me, I found it like a little bit subtle to think in those terms. So I thought that was like it was a good question. And obviously, keeping in mind that you only have half an hour to think about this. So maybe you spend like 15 minutes doing the math, and then another 15 minutes thinking about how you could most elegantly think through the case where the liabilities are riskier than the assets, even though they match in terms of starting market value and duration. Okay, so that was the final sample exam question. And let me stop sharing, turn it back to you guys. And I think everybody's already unmuted. So this is a chance for you guys to ask any questions. Obviously, you can still shoot me an email, and I'll try to respond over the weekend before your exam. No questions? So I can interpret that the course material was presented in such a crystal clear manner that it was there's no need to ask any questions. I can, so, yeah.
Yeah. Actually, this is a question about the course material.
Yeah.
I just I want to hear your comments about like the pension plans, they short volatility, like sell this deep out of money put options to set returns. So yeah, I just want to hear your idea about this strategy because, like the Abbott pension plan actually lost a lot because of this strategy.
Yeah. So yeah, there's you can think of it like there's two sides of the coin. So one way you could approach it is that, let's say you're running a value add trading desk program, and you're trying to beat your benchmark, and so you're trying to find like risk premia that you can exploit. So one of those risk premia is the difference between implied volatility and realized volatility. So as you probably know, implied volatility is typically higher than realized volatility, which means that you, in general, you get uh, paid for selling options. So people will pay you slightly more than the option is worth based on the realized volatility. So so therefore, like a volatility selling strategy is a way to kind of extract this risk premium out of the marketplace. Um, and so you would run this process like the one that you described, where you're kind of selling options, and so uh, you can imagine how like generally like that typically would make money, but then you have a market crash and it loses a lot of money. And we even talked about the example that you have to make sure that you make enough money to cover the drawdowns. Now the so the experience has been that generally speaking, these programs will, as you observed, like pension plans that engage in this have typically lost money. So, and not only the question to ask is, it's not really the right question to ask, like how much money you lost during like Q1 or during a market crash, but really the right question to ask is how much has the program made over its lifetime? Because it's a given that it's going to lose money in a market crash. It's like almost by design. So like if you're selling fire insurance and there's a fire, you're going to be losing money as an insurer. But that's not the point. The point is, did you collect enough money along the way that is still a profitable business? And so there's nothing to say that it's not necessarily a profitable business. Um, but so that's the more correct question to ask is what's the lifetime P&L for these programs? And I would just say from my own observations that the lifetime P&L for these programs is probably negative, meaning that you're actually not getting paid enough um, uh, premiums to cover your losses. Now, the flip side of the coin is that there's some pension plans that would be on the other side of that trade, in the sense that they would be using options. So they would be buyers of insurance, and so they'd be buying protection for their portfolio in a market crash. And the pension plans that did that made money. So so yeah, keep in mind that there's two different strategies. One is kind of a value add insurance selling strategy, which may or may not make money over time, and then another one is a tail hedging strategy, which costs you money in normal times but will pay off in a market crash. Now the thing is, though, you have to remember that like a dollar is not always a dollar, in the sense that sometimes it's much more valuable to earn a dollar than at other times. So whenever there's like a bull market, and the S&P is up like 15%, it really doesn't, it's not that big a difference if you made 16% versus 14%. But on the other hand, when there's a market crash, it makes a big difference earning those extra percentages. So if you're making a dollar and everybody else is making a dollar, that's like, okay, not a big deal. But if you're making a dollar when the market crashes, that dollar is very valuable for a lot of reasons. One is it smooths out your returns. The other is that it means you haven't drawn down enough, so you have less of a hole to dig yourself out of. And the third thing is that it provides you with liquidity that you're able to redeploy that in perhaps cheaper assets. So let's say your tail hedge paid off, you take the cash from that tail hedge payoff and you use it to buy equities when they're cheap. And so you kind of win on both sides. You win on the market crash and then you win on the recovery. So that's why I'm saying like earning a dollar during when everybody else is losing is very valuable.
Okay, thank you.
Any other questions? Okay, so let me just wish you all the best of luck in your careers. And yeah, there's obviously there's probably issues with companies hiring. Like I'm sure a lot of companies are just dealing with coronavirus. But on the other hand, though, when things come back, there's going to be a lot of mess to clean up in terms of you know, investing and loans and all that kind of stuff. And I'm sure that um, institutions are going to need people with your skill sets, and also just the we may be in an era where a lot of things are rethought and done differently, and we talked about that the other lecture about like dislocations. So you guys could be well living during like a period of a lot of dislocations, which is also a period of tremendous opportunity. And so you guys, once we get past this like lockdown period, hopefully you guys are well positioned for that, and it should be exciting careers for you guys in the future. And yeah, I mean, I've been doing this course for 8 years, and the people that have graduated are slowly working their way up the ranks in the financial community. So that's all great, and I feel like I've made my contribution by educating you guys, and yeah, wish you all the best. Okay, talk to you later, guys. Bye.